This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Hello, everyone, and welcome to the Financial Standard podcast. My name is Eliza Baven, and I'm a senior journalist here at Financial Standard. Charities may be unknowingly missing out on millions of dollars due to the failures of investment consultants. Unlike retail investors, not-for-profits do not have the same protections against conflicted advice, leaving them more vulnerable to costly and complex strategies. This can lead to consultants operating under a vertically integrated model, recommending their own products, burying fees in the fine print, and manipulating benchmarks to disguise underperformance. So to discuss more on this, I am pleased to welcome Stockspot's Chief Executive, Chris Brycki, to the show. Thanks for being here, Chris.
Thanks for having me on, Eliza.
So in what capacity do you work with charities?
Look, we've had a few charities come to us over the years to get advice on their investing strategy. They tend to be kind of small to mid-sized charities because the big ones are generally, well serviced by the big asset consultants that you described in the intro. But some of the smaller charities with anywhere from a few $100,000 to invest to probably 5 to 10 million, they don't typically get serviced by the big asset consultants. So if they do decide to invest some of their surplus funds rather than just leave it in the bank, they would come to a business like ours or other similar businesses to get some advice.
And how pervasive are the conflicts in the integrated consultant model?
Look, unfortunately, I from what I've seen from some of the strategies that have been recommended by some of the big asset consultants in Australia, it's quite pervasive. And again, like you described in the intro, those protections that got introduced for retail consumers after the Royal Commission haven't transmitted across into this area. So you often have a vertically integrated model where the asset consultant is basically just a sales representative for their own funds or fund of funds. And a transparency of those fund of funds is pretty poor. It's very hard to actually glean how much the asset consultant is making from the fee versus the end fund managers, and whether the end fund managers they're recommended have been compromised by the fact that they're prepared to split the fees, whereas there are some index products, for instance, that aren't prepared to do that.
How is this still able to go on? Was it just a sector that was skipped after the Royal Commission, as you mentioned before?
Look, I think the Royal Commission was really focused on retail investors and even wholesale investors don't have the same protections. And I guess charities or not-for-profits or institutions are even less protected because they're seen as being more sophisticated. In my experience, they're often less sophisticated because these boards are presided over by people that aren't from finance and, are often, very trusting of whatever they're told by the asset consultants and often don't ask sort of second order questions. And, something I've seen, for instance, is asset consultants, from what I've seen, 100% of the time will say that their strategy is done better than their benchmark or the index. We know for a fact just from the SPIVA studies and other, empirical studies that on average, they're doing much worse. And there's been a couple of big studies in the US that have shown something like 93% of charities that are actively managing their strategies are doing worse than just the index. And from what I've seen, there's a few ways that this performance is disguised. Often they're publishing pre-fee performance, which I don't know how this still continues, in any sort of form rather than after-fee performance. Sometimes they're using inappropriate benchmarks. So they might be benchmarking an infrastructure fund, for instance, to cash, where it doesn't really reflect the same risk. And then there are, other strategies that they use. For instance, survivorship is a big one. Asset consultants will often pull out funds that they've removed from their, recommended model from their history. And so it leads to a survivorship bias where it's only showing the performance of funds that have essentially survived and ignoring the performance of those poor managers they've pulled out of their strategies.
Wow, okay. So how do asset consultants justify their performance claims, particularly if they're underperforming?
Look, I've seen some pretty spurious claims out there where when questioned that they really struggle to justify them. So the typical pitch deck you'll see is that, asset consultants will claim that their expertise is in selecting asset manager or fund managers and timing the market. And so their value add is in manager selection and market timing. And then they'll generally show a chart that shows their performance versus some benchmark, and inevitably their line will be higher than the benchmark they've compared to. a lot of work goes on behind the scenes to be able to create that chart by usually a bunch of junior analysts at the business. And some of the fudging that happens is in basically removing funds that they no longer include in their portfolios and not including fees. And so that line will look better. From what we've actually seen in terms of actual realized performance, almost all of the performance we've seen have been worse than if that charity had simply plonked their money into low-cost index funds and rebalanced in a methodical way when the allocations move away from target allocations, rather than tactically trying to time the market and pick fund managers and pick stocks. And so there's a big disconnect between what's getting sold to charities and what their actual performance is.
So this underperformance in charity portfolios is actually really quite widespread.
Massively. I mean, in the US, a study was done of 28,000 not-for-profit endowments, and they found that the average return was significantly lower than the market. So the average return over 2009 to 2016 of these funds was 6.65%. That's compared to the benchmark that they were comparing themselves to of 7.96%. So basically a 1.5% underperformance. And even if they'd just put the money into long-term government bonds, they would have done better. So it really shows, the impact of high fees. Another area that I see these high fees come about in a lot of these endowment, these charity recommendations, but aren't properly disclosed is in alternatives funds. I know it's very popular these days, alternatives, private equity, venture capital, unlisted property, private credit. Some of these assets have created fund of fund structures that give you a diversified mix of these alternatives. But when you actually drill down and look at the total costs of these products, including the fund manager fees, performance fees, and the asset consultant costs, they're in the range of 2 to 3.5% per year. And there's just no way that these funds can generate that level of alpha year in and year out to justify those costs. And so those costs are really killing these charities. And it's quite sad from my perspective, because that money should be going towards the cause that this charity has been set up for, rather than the fund managers that are managing the money.
Yeah. So is it still appropriate to have private equity and private debt solutions in charity portfolio monies? Do you think there's a place for them?
Look, for a lot, there isn't, to be honest. It adds a level of complexity that's just absolutely not needed, especially since a lot of these assets have been shown to be really over the long term just a leveraged version of equities anyway, with higher costs and less liquidity. And liquidity is really important for charities, because it's usually when times are tough and markets are tough that donations fall as well. People that are donating to charities are usually donating more when times are good and they're making money in the share market. And so, COVID was a great example. A lot of charities saw a big drop-off in donations. That's the time they most needed liquidity in order to meet what they were trying to do that year. And if you have a high allocation to some of these assets that actually get locked up during periods of low liquidity, it's completely against, the goals of the charity. So, I don't think, for those two reasons, liquidity needs and the level of sophistication and complexity are required, that they're really needed at all.
So what kind of disclosure rules currently apply to investment consultants serving charities? It doesn't sound like there's an awful lot of oversight.
No, I think the oversight's quite light. I'm not sure exactly who's regulating them or who's keeping an eye on what they're actually displaying. But having a look at some of their pitch documents, I know if Stockspot as a retail investment product were to put these online, we'd get very quickly scrutinized by the regulator and asked to pull them down. There's a lot of performance claims that are unsubstantiated, that aren't properly disclosed, that are pre-fees, like I mentioned before. Unfortunately, it's just not an area, probably like institutional investing or wholesale investors, that gets a lot of focus, because rightly so, the regulator's focus is on protecting retail consumers. Unfortunately, I think, just the level of sophistication of, these charities and also some wholesale investors, isn't up to where probably even the regulator thinks it is.
So what kind of regulatory scrutiny would you hope to see in this area?
I mean, it would be great to see a similar level of regulatory requirements that sort of match up with the retail protection. So, for instance, in marketing, there's very strict requirements that any retail investing product needs to meet in order to talk about past performance, to disclaim, everything they need to really disclose and disclaim in those statements. It would make sense to me that similar levels of disclosure are required when asset consultants are, pitching to charities and showing past performance. And I would love to get the regulator to drill into some of these pitch decks that charities are seeing to really ask the questions. I'm just not sure whether many of them are getting circulated more broadly than the investment committee meetings. The other reason they don't get circulated is one of almost self-protection and self-preservation. When asset consultants recommend a strategy that doesn't work out, it often embarrasses the investment committee. So they don't really want to own up to it either. And it's very difficult for them to break up with the asset consultants because that is an admission that they've made a mistake as well.
Well, I can't imagine many of the consultants would agree with these views, obviously, for obvious reasons. But are you expecting any kind of pushback from calling for this kind of increased scrutiny in the sector?
Oh, of course. I mean, asset consultants have, a business model that's, very profitable, and, it really kind of escapes the eye of the regulator in many areas. So no doubt the big profit pool that exists in serving charities in Australia and overseas as well is one that they're going to want to protect. And I'm sure that, they'll do everything in their power to ensure that, the status quo remains. I think, Stockspot and myself, we've always been, a consumer champion out there trying to represent the end customer, and in this case, the charities. And I think it's worth talking about, just like we did. And years ago, I remember chatting to you, Eliza, about the Fat Cat Funds report. By actually exposing some of these underperforming super funds, it got APRA to take a closer look, and now it has its own performance test, which is doing the same job that we used to do. So I think sometimes it takes someone out there to really kind of expose issues for others like regulators and politicians to take notice and actually take some action.
Well, Chris Brycki, thank you so much for joining us today. Really appreciate it.
My pleasure. Thanks for having me on.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.